the best attribute you can have is a long time horizon.
Right.
So time in the market rather than timing the market.
Wayne, you're Chief Investment Officer of MissionSquare. Thank you very much for joining us today.
Yeah, my pleasure, Jamie.
So before we get into your views, because you have such a wealth of knowledge, having been in the market for, I'm not saying you're old, but I'm saying you've been in the markets a long time. But why don't you tell us a little bit about MissionSquare itself and what the sort of investment process is there?
Yeah, well, this year is our 50th anniversary. We were created 50 years ago this year. We were built to help fund public sector employees, primarily city managers, for their defined contribution plans. And over the years, we've grown that business, and we serve a broad array of public sector folks that tend to, serve us all day long. We have about $68 billion in assets. We run that across roughly 31 different CITs, which were formerly mutual funds, that our participants can choose from. And we offer a broad array of services, including financial planning, record keeping, and a number of other things.
I've had other people say, who've been in the markets a while, that now is about as difficult a time as they've seen in recent memory of investing. It's tough to see old correlations break down, and we're into a new era. How would you see sort of markets generally today across the board?
Yeah, every market cycle is different, and they all seem really hard, by the way. and I started out my career a long time ago, as you alluded to earlier. Yeah. And when I got out of school, interest rates the 10-year was at 15%. And inflation was rising about 18%. And that was a pretty challenging time. But every single cycle is a little bit different. And we find ourselves in one today. In some ways, it's a little better. We've got full employment. We seem to be having great corporate earnings. But of course, everybody's concerned about inflation. And so that combination, combined with geopolitical events going on over the world, I think makes it a little hard for investors to try to figure out what the right path is these days.
There's an opinion that the Fed may not be able to tackle inflation, and the reason is that this inflation rise is more supply-led than it is demand-led, and that's what the central banks can do, is raise interest rates to tackle the demand side of things. But because there's so many sort of supply shocks, that's what's driving, and really the Fed raising rates may not have as big an effect on inflation as it may have done in previous cycles. What kind of view do you have about how effective the central banks can be now?
Yeah, well, that's a really good point, because if one of the main drivers of inflation is either going to be labor or energy, the Federal Reserve is going to have a real challenging time on the energy side of things. Raising rates simply won't curb price increases there. But what I would say is, the Federal Reserve, there's a feedback loop to a certain extent. And if the market believes that the Federal Reserve will attack inflation through rising interest rates, it does tend to have a secondary effect with consumers, maybe either pulling back if they start to see layoffs on the horizon, which will ultimately slow the price of goods and services that are being purchased these days. Labor is an area that I think goes in cycles, and right now we're seeing a big upswing on labor.
Strongest labor market for a long time.
Strongest labor, and with that comes higher rates, because we all have to attract people to fill those jobs. That maybe is a little more long-tailed in terms of how long that takes to roll over, but I think that some things are in the control of the Federal Reserve, like monetary policy, tightening up, making it a little bit more challenging for businesses to just take free money and spend it. Others, such as labor or energy, may take a little bit longer.
And if you think about the sort of quantitative tightening that's now going on, there seems like there's a lot of quantitative easing to unwind. How do you think that plays out, particularly in terms of the credit markets? Where do we see yields going from here?
Well, I think there's two schools of thoughts there, and I'll preface that by saying I'm not quite sure. There's one school of thought that is in the camp where inflation may be peaking fairly soon. We see certain industrial commodities rolling over in price today, and we think that in that scenario, you may have seen yields starting to peak. Others are in the camp, obviously, that it's going to take a long time for the Federal Reserve and monetary policy to take hold, and in that particular case, you're going to see rates moving up much higher. What I would say for most investors is that in an area such as this where it's a little gray, probably is not a bad idea to think about being a little bit more conservative in your portfolio, since you don't know what the future is going to hold. We're in a pretty good spot right now relative to other times when we were potentially going to enter a recession, and the fact that balance sheets are better off than they've been in a long, long time.
So does it just kind of feels like the economy's in a worse position because we've had this kind of pullback in markets so far this year, but really you've just got to look at the bigger pictures that we're still at really attractive levels in terms of the S&P 500 is up a lot from 10, 20 years ago and that sort of thing. I mean, do we just need to try and be a bit more a bit more top down and a bit bigger picture about these things?
Well, I think the biggest ally for people trying to, navigate through the current environment, the best attribute you can have is a long time horizon. Time in the market rather than timing the market is, I think, so appropriate, especially for uncertainty like what we have today. I think that, Fidelity did a study not long ago that said, if you put $10,000 in the market back in 1980, at the end of 2021, it was going to be worth something like close to $700,000.
Right.
If you miss the 5 best days, it's closer to $480,000. So, investors won't have a really good prescient way of navigating those future events. But I do know that as we think about markets and the upward bias that they have, as long as you are within your risk tolerance, it would seem to me that you take a little bit more conservative approach in a rising interest rate environment, but you stay the course.
Just paraphrasing, and if I can ask about equities in particular,
Yeah.
Even though we've had this pullback, it's still your view that over a very long period, there's still an asset class that will return, let's say, 5 to 10%. You just really need to have this longer term horizon. And if you're looking at your portfolio and hurting, just kind of take a breath and realize that over the longer term, it should play out.
Well, so Jamie, here's how I think about it on those really volatile days. I look back at a chart that Ibbotson put together from 1926 on calendar year returns through this last year, 2021. And what's really surprising in those 96 years of observations, over 74% of the time, the market has been positive in a calendar year. And more remarkable is 59% of the time, 59% of those observations, the market's up greater than 10%. For that, you are taking, it's a risk asset. And so for that, every once in a while, you'll have a down year like the one we're experiencing today. But again, if history continues to play on our side for the next 100 years, I think that investors are well placed to take advantage of the natural growth that we see in business here.
Could I ask about alternative assets? And I mean particularly in the private equity market and venture capitalism. Do you think that's an asset class which, going forward, funds like yourself will put more capital towards, or do you still think that will remain a relatively small part of most people's portfolios?
Well, I think that certainly alternative assets play a role in a broad range of portfolios. What's happened is it's transitioned in terms of who the asset owners are. It used to always be pension funds back in the 80s and 90s. Today we see a broader number of constituents using alternatives. Endowments and foundations lead the way. We see that in private wealth management firms to a certain extent. And several people are trying to bring it to the retail market. What I would tell you is that there will always probably be a place for alternative assets. It's very complementary to public asset classes such as stocks and bonds. They're different vehicles with different return and risk patterns. And so I think that there's always going to be a place, and it'll probably have a growing appetite, especially if public equities and publicly traded bonds have lower rates of return, people are going to be reaching for that risk premium that's typically affiliated with private equity, private credit, and real assets.
How do you think about digital assets right now? I know that's a topic that is at the forefront of many people's minds. Is that an area where you're allocating capital to, or think you will do more of?
Jamie, we haven't done anything in digital assets, and I think that we're certainly interested in we're in the early stages there, and we don't have enough actual return data to make any judgments in terms of where we believe volatility is for this asset category, how correlations play out versus other asset classes. It's so embryonic at this point that we're sitting on the sidelines right now with cryptocurrencies and other facets of digital assets. That's not to say that they don't have a future, but we'd like to study them a little bit more before we actually put our clients' money into them.
It seems like some of the biggest issues currently are really central banks and inflation. Perhaps we're in a commodity super cycle. The idea of digital assets, we'll see how that plays out. But what are the kind of other topics do you think we need to be paying attention to, or we will be talking about in 6 to 12 months' time?
Well, I think that the market is locked on right now to the rate of inflation.
Right.
And so a couple of those drivers, whether it is the price of a barrel of oil or how wage rates are going, and to a lesser extent where employment is.
Right.
Those three factors are key contributors to the rate of inflation. And I would say that the inflation that we aren't anticipating is always the inflation that really nails fixed income investors. Yeah. But I think the market has already embraced that, and they have probably taken down bonds to a certain extent already in anticipation to that. But certainly over the next 6 to 12 months, I think the conversations that the Federal Reserve will be having after each meeting will be a driver in where markets are moving. And certainly, I think investors are going to watch how all of this impacts earnings for corporate America, because in the long run, it's earnings that really matter.
That's what's right. All right, well, we'll keep an eye on earnings.
Okay.
Wayne, thank you so much for sitting down with us. It's always great to hear your advice.
Thanks, Jamie.